Property investment's risky. There, I said it. It is risky, but the risk isn't what you think. It's, in fact, not what most investors consider when they get involved in property investment. What most people think about risk is wrong. What most people have been taught about risk is wrong. But I'm going to share with you some ideas that are going to make you a better, safer investor when you understand where the risk really lies. And then I'm going to have a chat with Pete Wargent about 3 important considerations that will be affecting the value of properties over the next decade, some things you may not have thought about, and in my mindset moment, I'm going to share with you a lesson that I learned from one of my mentors that changed my life. So welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
Today I'd like to share with you some of my thoughts on risk and how it relates to your investment success. Because I believe that most of what's been taught about risk is wrong. In fact, it's probably holding you back from obtaining real wealth. If you're like most investors, somewhere along the line you've probably heard that there's a continuum of risk associated with different investment vehicles. At one end, there are low-risk investments, and at the other end, there are highly speculative ventures. Most believe that any investment can be placed somewhere along this continuum, that in general, the higher the risk, the higher the reward. And somewhere along the spectrum sits property. Of course, within the property sector, houses are considered to be safer than vacant land, while commercial and industrial real estate is considered riskier, as valuations can fluctuate more. And then there's the common wisdom which suggests that properties in capital cities are less dicey than regional areas. The innate problem with this approach is that while we're taught to evaluate the level of risk in the investment itself, as well as general market risk, there's one critical factor missing. And that's you, the investor. Imagine you're considering undertaking a small residential development. Now, is this risky? Well, in isolation, this question is impossible to answer because we don't know enough about you. Have you ever invested in property? Have you ever completed a development before? Now, if you've got no knowledge about residential developments, or if you've never owned an investment property, no matter how good a deal that development could be, it's going to be a risky proposition. Essentially, it's impossible to distinguish the risk without assessing you, the investor. Of course, you could turn to a trusted advisor to help you make up for your lack of knowledge, but the only way to unfailingly lower your own investment risk is to become an expert in a particular area. And how do you know when you're an expert? Well, you have to consistently outperform the market in that given investment niche that you've chosen. You've got to continuously outperform over time, preferably a comfortable of investment cycles. See, the trouble is a lot of people thought they were real experts a few years ago when they bought in Melbourne or Sydney, and they weren't. They were carried away by a booming property cycle. The worst thing an investor can do is get it right first time. They think they're smarter than they are. Now, to be honest, that's what happened to me when I bought my first investment property in the early 1970s. Inflation went wild. The Whitlam government came in, inflation went wild, my property went up in value, and boy did I think I was smart. By the way, the market humbled me in due course. So what I'm suggesting is you've got to become an expert. An element of risk is inherent in any investment, but the truth is that you, the investor, are the biggest risk, the biggest variable of all. The difference is generally in your skills, your contacts and your expertise. Over the years, I've seen people make a lot of money out of real estate, but I've seen even more people lose money. Sophisticated investors manage to obtain higher returns without taking a high degree of risk, which is the exact opposite of what conventional wisdom tells us, isn't it? So let's look at some of the primary factors that determine the risk level associated with an investment. So number one is expertise, your network of contacts. That could be your biggest competitive advantage. Or your most potent risk factor, investing in your specialty area is going to allow you to achieve higher returns because, as an expert, you're going to be able to find opportunities that the average person can't. What contacts do you have who can help you make an informed decision or let you know about an investment opportunity before others do? What do you know about investment opportunities that others don't, about timing in the property cycle or about changes in government legislation? For instance, a visit to the local council might uncover plans to rezone a particular area, something that may allow you to build multiple units on a site where before you could only build one dwelling. This, in turn, could make the property that you're looking at even more valuable and your investment less risky. You see, real estate's what I call an imperfect market. If real estate was perfect, liquid, you wouldn't be able to buy property considerably below market value. Information, contacts and expertise help you in an imperfect market. They make investments less risky. By the way, you could increase your expertise by getting the right team around you to help you. Okay, so we're working through the different risks that could affect you. The other one is control. The more control you have over your investment, the lower your risk. When you buy shares, you've really got no control over the company. You can't tell Coles Myer to put the Fabula on the top shelf or to make it more accessible. You've got no control. But that's one of the reasons I love real estate. I have control over my properties. I can add value through renovations or redevelopment. I can change my property manager. I can even furnish my property if it's appropriate. I've got control. Transparency is the third element to assessing risk. Is all the information about your investment disclosed? Of course, the more you know, the lower the risk. When you invest in shares or property trusts, you've got partial disclosure. There are guidelines as to how publicly traded companies have got to report to their investors. But if these worked well, there wouldn't be as many stock collapses around, would there? So I like property where you can get a lot of the information as doing your research. Another element of the riskiness of any investment is liquidity. It means the ease of which you're able to recover your money by selling the investment or converting it or part of it into cash. Of course, the greater the degree of liquidity, the lower your risk. Now, let's be honest, real estate's not a liquid asset, not like shares or managed funds, because even though you can sell your property, it takes time, it takes effort and comes at a cost. Of course, smart investors never sell their property to release cash. Instead, they refinance and draw down on their unused equity. Your own liquidity is another major risk factor. So all the smart property investors I know buy the necessary time to see them through a property cycle. They have financial buffers, and the more buffer you have, either in a line of credit, an offset account, cash reserves, the easier it's going to be to weather a storm. And they will come. They always come. Without a sufficient buffer, especially in the more turbulent times, you're at risk from things such as interest rate hikes, extended vacancy periods, losing your job, illness. As we're working through the risks that you've got to assess when you're making any type of investment, another thing to look at is the returns. Now, property investors get returns from the investments in a number of ways. First of all, cash flow, the rent you receive. Now, that's not the main reason to invest, but it's definitely important. It helps pay the mortgage. Capital growth, the increased value of your property. Forced appreciation, that's one of the ways of getting a return that I love. The value that you get when you manufacture capital growth by undertaking renovations and developments. Tax benefits, that's another way that you get money in property investment. So the more secure the returns, the less risky the investment's likely to be. Another thing I always look at when I assess the risk of an investment is my principal, the money I outlay at risk. Is your financial outlay secure if the investment fails? An initial cash investment, your principal in a bank term deposit, is considered very secure. Whereas if you buy shares, it's possible the company to fail and the shares to become worthless. With property, you generally have to put down about 20%. So if the value drops by more than 20%, your equity, your deposit, the money you got in there, could be wiped out. The overall median house price of Australia doesn't fall by 20%. I know people say it will fall and that we're going to have a crash and an Armageddon. If you genuinely believe that, you shouldn't be buying real estate. But if you're listening to this podcast, you're not going to believe that. So it hasn't happened during wars. It hasn't happened during depression. But I've come across investors who have had their equity wiped out. Some highly geared investors who did buy near the top of the cycle and then the market fell, they got themselves into trouble. Others paid too much by buying off the plan, and on completion, the value of their property was considerably less than the contract price, and they just lost their deposit plus more. Sure, occasionally value of individual homes have fallen over 20%. They're in the wrong areas, the wrong locations, especially in the regional Australia or the mining towns. That's why you've got to only buy investment-grade properties, because the more secure your principal, the money you put in, the less risky the investment. Another thing I look at when assessing an investment is, are you personally liable? Because when you make an investment, sometimes you have to give a personal guarantee. This gives others, the banks, the right to pursue you if things go wrong. Now, your liability extends beyond the asset itself, such as when you personally guarantee the loan for a property bought in a company or a trust. Your personal assets could also be at risk. In this instance, if things go belly up and the bank sells your property and can't recover all the debts, they're going to chase you for the difference. Often, banks require you to take out mortgage insurance for just that sort of thing happening. But remember, this protects them, not you. Mortgage insurance pays the banks, and then they chase you for the money with interest. Obviously, the more you're personally liable, the higher your risk of an investment. Another risk that we're all aware of is the market risk. Some risks are just inherent to certain markets. For example, if you invest in tourism, you're subject to the investment market collapsing if there's a natural disaster or if something affects tourism. I remember Bali's economy almost crumbled a number of years ago after the bombings, and then there was the Asian bird flu crisis. I don't have to tell you what happened to those who invested in mining towns, do I? When weighing up risk, consider what the impact of the general economic changes do to the marketplace you've invested in, and invest in markets with multiple pillars supporting them. And that's why I only recommend you invest in the big capital cities of Australia, not smaller areas. Sure, there are opportunities in regional locations, but I like an investment which has got multiple pillars supporting the economy and then multiple types of purchases if ever you have to sell, and even if you don't plan to sell, just to hold up the value of properties in your region. So I like it where there's also first home buyers, upsizers, downsizers, established home buyers, not just investors, because investors are very, very fickle. So market risk is important. And then there's risk spectrum. This is the risk specific to the particular investment you're looking at. Is it the right property in the right suburb, at the right price, and at the right time of the cycle? When assessing risk, most investors only look at these last two factors, the market and the specific investment risk. And they rarely focus on those other factors I've just shared with you, which in many ways are even more significant. So think about it. You're going to have your own risk spectrum too. Whenever considering an investment, don't look at the investment alone. Look at yourself too. What type of investment choices are low risk, medium risk, high risk for you? And remember, you can change your risk spectrum by developing expertise, by becoming a better investor, by educating yourself, but you can also widen your risk spectrum by getting the right people around you. And that's why many, even experienced investors, turn to the unbiased independent team at Metropole, my team, who've been involved in over $3 billion worth of property investments. Our property management team look after close to $2 billion worth of properties under management. We have a wealth advisory arm. We've got a renovations arm. We've got a construction company, a development arm. I've been involved in property developments in the middle 80s. We buy commercial properties, we buy homes, we buy investments. Nobody has got that type of depth to help you. So why not have a chat with the team at Metropole? Go to metropole.com.au, click on the link and organise a free strategy session with one of our property strategists. They don't sell properties. They work out where you want to be now, where you want to get into in the future, and we will help you devise a plan. We put together strategic property plans, very detailed plans showing you, are you on track to where you want to get to? What are the options? What you can do? We'll help you organise finance. So with no properties for sale, but so much depth and expertise on our side. Let us help you. Let's help you level the playing field. That's the sort of perspective money can't buy. Metropole.com.au, and I personally look forward to being part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's Mindset Moment, I'd like to share a message I learned from one of my mentors, Jim Rohn, who explained if you can change yourself, you can change your life. What Jim Rohn said is life is about constant, predictable patterns of change, and the only constant factor will be our feelings and our attitudes towards life. He said, we as human beings have the power of attitude, and that attitude determines choices, and the choices determine our results. All that we are and all that we can become has indeed been left up to us to decide and interpret through our attitudes and our choices. Jim Rohn said, life is like the changing seasons. You can't change the seasons, but you can change yourself. So the first major lesson in life is to learn how to handle the winters. They come regularly, right after autumn. Some are long, some are short. Some are difficult, some are easy. But they always come right after autumn. And that's never going to change. Jim Rohn said, there are all kinds of winters. The winter when you can't figure it out. The winter when everything goes awry. There are economic winters, social winters, and personal winters. Winter times can bring disappointment, and disappointment is common to all of us. So you must learn how to handle winters. You must learn how to handle difficulty, because it always comes after opportunity. That's never going to change. The big question is what to do about winters. Jim Rohn said you can't read January simply by tearing it off the calendar. Of course, he was talking about the American winters there. So he said you can't just tear it out of the calendar, but here's what you can do. You can get stronger. You can get wiser. You can get better. Remember that trio of words. Stronger, wiser, better. The winters won't change, but you can. Before I understood this, I used to wish that it was summer when it was winter. When things were difficult, I wished they were easy. I didn't know any better. But then my mentor gave me the answer as part of his unique philosophy when he said, don't wish it were easier. Wish you were better. Don't wish for fewer problems. Wish for more skills. Don't wish for less challenge. Wish for more wisdom. So the bottom line is, if you can change yourself, you can change your life. As a property investor, we need to make long-term decisions. You need to own the sort of property that's going to be in continual strong demand in the long term, not just today or tomorrow. And that's why demographics is important. But according to prolific author Pete Wargent, there's 3 other important considerations for the next decade ahead. So welcome, Pete.
Pleasure, Michael.
Pete, I read your blogs and I watch your videos, and recently you had a discussion about 3 real estate considerations that we should take into account over the next decade. Would you like to share them with us?
Yeah, sure. Because when it comes to the real estate and future price performance and all of that stuff, which is so important to property investors, it's really driven by the interaction of a number of different drivers. So the 3 things that I think people need to think about for the decade ahead. Firstly, the cost of land. Secondly, the cost of construction, because all of that new housing will cost potentially more, but not everywhere. And the third thing you need to think about is the cost of money, because we've gone through a period where interest rates have been very low, but that won't continue forever. So I think the first thing to consider the cost of land.
Okay, so the cost of land. One of the things we recognise, Pete, of course, is that not land is created equal, and so therefore you want to own the sort of land that is more valuable.
Yes, and this is where I do travel a lot, and I try to learn from cities that have seen strong population growth and have developed very quickly over the years. And Australia has a couple of those cities, Sydney and Melbourne. What I've learned from international markets is that there's in certain areas where suburbs are landlocked and there's massive demand. The cost of land can just explode over time. And because it happens bit by bit, you don't necessarily notice it so much in real time. But over the course of a decade or 2 decades, there can be a massive increase in the cost of land. But it doesn't happen everywhere. Certainly doesn't happen out on the city fringe because there's just simply more land. It's simple geometry. It tends to be the landlocked areas that are close to the big employment hubs.
Pete, what you were saying then is one of the considerations we have to take into account as property investors is the cost of land. And in my mind, the land, the buildings, the apartments, the houses that are going to be close to public transport in the future, close to amenities, close to shops are going to be very important. We discussed that on a previous podcast, but walkability, ability to hop out of your house and walk quite easily to public transport, that's going to be pretty important, isn't it?
Yes, absolutely. In fact, increasingly so. If you look at the census figures, if you actually dice them up and look at where young people, and that's what Australia's immigration program is targeted at, young people, where those people are heading, it's generally the inner suburbs of Sydney and Melbourne. And then internally, people move around a bit more, but that's where the price is going to be at a premium on land. It's really areas that are within a sort of a 10 or 15-minute journey from the centre of Sydney and Melbourne and some of those big employment hubs.
So as we're talking about the three main drivers of property over the future, one is the cost of land. So it's not the size of the land, it's how valuable the land is. And if you're buying a property, you want something with a high land to asset ratio so that the value of the land as a proportion of what you're paying is high. What's the other drivers?
Well, the cost of construction. So the ABS did a really interesting piece in Australia on this quite recently, and it showed that the cost of building a new house in Australia has increased by about 75% over the past 15 years. The cost of building a new apartment is up by more than 50%. So generally speaking, it does cost more to construct things over time because you have to build them using today's materials prices and the cost of today's labour. But there's an interesting thing to consider here, and that's whether for some of the sort of generic type of project homes out on the city fringe, where the advances in robotics and 3D printing and prefab and precast concrete, I mean, the cost of construction might actually not increase at all for that type of housing, at least in real terms after you adjust for inflation. So I think you need to be a bit smart about the type of property that you buy, because the more desirable type of stuff, well, that's always going to be tricky to build to a high spec. Not least because of land remediation costs as well in the inner city and those landlocked areas. But you need to be a bit wary, I think, especially in some of the cheap high-rise towers, but also the sort of project homes out on the city fringe.
Sure. During boom times, people buy anything. They buy everything, anything to get in the market. But we've noticed that as the market changes, there's a flight to quality. So during good times, all those cheap homes, the apartments, the project homes are going to sell, but at more challenging times like we're currently experiencing, and the cycle will go on and we'll experience them again, we need to only own A-grade homes, investment class assets. So you're right, Pete, let's be careful about the sort of assets. So number one was the cost of land. Number two was the cost of construction. And at the beginning, you were suggesting the third one is the cost of money.
Yeah, so that's been the big structural change since, say, our parents' generation. Certainly for my parents, I can remember them arguing about the price of the mortgage, interest rates in the double digits. And that's changed a lot since the early 1990s in Australia. So now we've got the cash rate at generational lows. We can borrow money at anywhere from, I guess, 3.5% today. So the cost of money isn't going to get much cheaper over the next decade or two. But the important thing to remember when it comes to investment is you want to actually make a return that beats inflation, because the cost of living is rising more slowly too. So you need to keep a buffer just in case we get periods of interest rates rising, but also just have an awareness that we're not going to see the big drops in the cost of money that we've seen over the past couple of decades.
Pete, I remember that 17 and 18% interest rates in the early 90s. But I do remember for many years, if my home loan was less than 10% interest rate, I would be really happy. But having said that, you brought up a good point that many people forget. It's the real cost of money after inflation. It's the real capital growth of your properties after inflation. So if inflation was, as it used to be, 8 and 9%, yes, your properties had to go up with double-digit growth. Otherwise, you were falling backwards. Having said that, a couple of years ago, when Melbourne and Sydney properties went up with double-digit growth, but inflation was only 2%, wages were hardly going up, that was unsustainable. So I agree with you, Pete. We're now moving into a period of lower inflation, lower wages growth, lower capital growth. You don't need double-digit growth to get ahead, but there are ways of improving your capital growth by choosing the right location, by one-off manufacturing some capital growth by doing some renovations or development. But it's really important to have asset selection right, because some properties are always going to outperform others, aren't they?
Yeah, that's it. And at the macro level, and we've seen this with the credit squeeze, there's always things that can be done to increase or decrease the demand for housing. And in the UK, I see even the Labour Party talking about a house price inflation target and all kinds of crazy ideas. But the problem with this kind of macro level intervention is that it still can't easily differentiate between cities and suburbs and outer and inner locations and all the rest of it. And there will always be some areas, because of supply and demand, that will outperform others. If you're in the market for any kind of meaningful period of time, you just want to make sure you're in those areas and not in the areas that will struggle.
Well, it's interesting that you say overseas there are the same issues as here. There have always been issues of affordability, and governments have always tried to help first homeowners, and I have no issue with that. I'm very sympathetic, having in my blended family 6 kids and 10 grandchildren, some of them in the property market, and the grandchildren are going to be in that period in the future also. Having said that, I don't want to make the value of my home and your home cheaper to allow young people into the property market. That doesn't help anybody, because once they're in, they don't want property values to drop anymore, like some factions are currently suggesting, make everybody's house worth less. Let's make us more productive. Let's help us earn more money so we can get into the property market.
Those issues will always be there, but in some parts of Australia, housing is very affordable, other parts not. So it's an issue that's not going away anytime soon. Yeah, it's just something to be aware of.
I guess housing's affordable in areas where people don't wake up in the morning and say, hey, that's exactly where I want to live. Pete, you've given us 3 things to think about that will lead to property price growth over the next decade. If people want to follow your blogs, read more about your research, where can they find you?
Easiest place to find me is just to Google my name, petewargent.com, and my daily blog is at Pete Wargent Blogspot. So there's always plenty of interesting stuff there on a day-to-day basis too.
Boy, is there lots of graphs as well. And of course, regularly your graphs and your findings are published in Property Update. Thanks a lot. I look forward to having another chat with you real soon.
Always a pleasure. Cheers.
I hope you benefited from today's show. And if you learned something, why not help somebody else? Just like I want to help as many people as possible to become financially literate and lift themselves up, I'd like you to do the same by passing the message on. Tell somebody about the podcast. With the click of a button at the bottom of every podcast app, you can share it. Share it with somebody. Tell somebody. That would make me really, really happy. And also, I appreciate it when people like you leave me a review on iTunes or whichever app you're listening to the show on. So I got one just recently, number 1 for Australians, from Dale Debus, a 5-star review on Apple Podcasts, saying, I enjoy listening to Michael at work while I'm saving for my goals. This podcast gives me hope for the future goals and keeps me on the pulse that's going on in Australian investments. Thank you. And there's also one here from Millie the Mouse that was left on Apple Podcasts too. I learned about this podcast from my mum, and I'm saving, using the tips from Rich Habits section to buy my first investment property. Hearing Michael's story has given me the confidence that I can create financial freedom for myself. Thank you. Well, thank you for leaving that podcast, Millie the Mouse, 123. And I look forward to giving you some more tips to become successful in property, in money, in general, twice a week, through the Michael Yardney podcast. Catch up with you real soon. In the meantime, spend your time wisely.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?